Today, crypto prices in the red as Luna Foundation sells $3 billion worth of Bitcoin. Plus, Morgan Stanley says NFTs could be the next trouble spot in crypto markets. And we look at how crypto's energy usage is driving the push towards proof of stake. Welcome to CNBC's Crypto World. I'm Pippa Stevens. Red across the board again for crypto prices. Bitcoin is down under the 30,000 mark again. Ether dropped more than 2% to hover at just above $2,000. And Terra's Luna token continues to flatline near zero as investors continue to flee the stablecoin chaos. That brings us to our first headline. The Luna Foundation Guard says it sold $3 billion worth of Bitcoin last week in a last-ditch effort to save Terra USD, or as it's also known, UST. As of Monday, the Luna Foundation had just 313 Bitcoin left in its reserve, worth about $9.3 million. The foundation also said it would use its remaining $85 million of crypto assets to compensate remaining users of UST. UST has been caught up in an epic crash of stablecoin prices over the past week. Now, UST is an algorithmic stablecoin which relies on complex code instead of fiat currency to back its prices. And it's also tied up with Terra's Luna token, which plummeted to zero in the stablecoin sell-off. Holders of both UST and Luna have lost a total of $42 billion over the past week during the stablecoin chaos. That's according to analytics firm Elliptic. Morgan Stanley says investors should be watching the NFT market according to a recent research report. CoinDesk reports that Morgan Stanley analysts think that crypto's deep sell-off from the past few weeks hasn't been because of ongoing volatility in the stock market. Instead, rampant speculation coupled with, quote, limited real use demand has caused investors to flee. What's also been seeing rampant speculation with questionable demand? Well, non-fungible tokens and virtual real estate, according to Morgan Stanley. Bitcoin-friendly El Salvador is hosting 44 countries and central banks today in an effort to encourage crypto adoption. It's been 8 months since El Salvador became the first country in the world to treat Bitcoin as legal tender. And so far, the Bitcoin experiment has not been working out, at least on paper. The ongoing chaos in crypto markets has amounted to a $40 million loss for El Salvador's Bitcoin holdings. That's nearly the same amount as its next bond payment to foreign creditors, according to estimates from Bloomberg. For our main story today, I took a deep dive into the data behind crypto energy usage and how it compares to other electricity-hungry industries like data centers. It's a huge part of the push toward proof-of-stake mining. Here's why. Countries around the world are waking up to cryptocurrency mining and its environmental impact. Specifically, they're concerned about a means of verifying transactions or consensus mechanism known as proof of work. In this kind of network, miners compete to solve complex equations to validate a transaction. Whichever miner solves the equation first gets a reward. It's become a huge industry and a highly energy-intensive one. Now, governments are taking note. In Europe, there was the proposal to ban proof-of-work mining across the continent, although it ultimately failed. In New York State, lawmakers are considering a 2-year ban on proof-of-work mines, and 12 U.S. congressmen just signed a letter asking the Environmental Protection Agency to investigate the environmental impacts of crypto mining on communities.
It's getting to a point where governments can no longer ignore this type of activities. First of all, because it is overstraining certain grids locally, but also because we're trying to meet our climate goals, and we see that Bitcoin itself, with all its electricity consumption, is responsible for a significant amount of carbon emissions.
But just how bad is crypto mining for the environment, really? Well, according to Morgan Stanley, much worse than traditional finance and other industries. Research from the investment bank shows Bitcoin consumes more energy globally than the entire power grids of the Netherlands, Kazakhstan, Belgium, or Austria. Each Bitcoin transaction generates about 1.4 tons of greenhouse gases. It would take 2.6 million Visa credit card transactions in order to reach that level. Yearly energy use for Bitcoin has largely trended higher for the past 10 years, reaching about 124 terawatt hours, according to the Cambridge Center for Alternative Finance.
the regular financial system processes more than 700 billion non-cash payments every year. The Bitcoin network can do just 100 million. It can process, the Bitcoin network can process a handful of transactions per second at most. That is just a very small fraction of total global payment volume, but ultimately the price that we're paying for that, on the energy that's used to make it happen, is a lot more than we're using for making all those other transactions happen.
While governments are looking into potential bans on proof-of-work mining, proponents of crypto say that will do more harm than good.
Bitcoin mining operations are providing high-paying and great jobs for local communities. One of our members, their average pay is $80,000 a year. If the United States, if more states followed suit and had an aggressive stance against proof-of-work mining, this, at the end of the day, is a digital ecosystem, and it will move where it is most welcome.
One solution to proof-of-work's reputation would be a pivot to clean energy. Things like wind, solar, and hydroelectric power have already seen mass adoption from cryptocurrency miners as they try to cut down on emissions. Facilities are also partnering with power grids to adapt to changing energy demand.
The Bitcoin miners can power down and provide that energy back to the grid with no consequence. Traditional data centers can't do that. Traditional data centers run air traffic control and traffic lights and hospital databases. You don't want to turn them off.
There's also network upgrades that cryptocurrencies can make. Proof of stake is way more efficient than proof of work. In Bitcoin mining, multiple miners fight to be the first to verify a transaction, meaning wasted energy. Proof of stake, on the other hand, lets miners stake or lock their tokens on a blockchain in the hopes of being randomly selected to verify a transaction. That means one miner per transaction. Morgan Stanley estimated that proof of stake mining is 1.5 million times less carbon intensive than proof of work. Ethereum's network is already in the process of transitioning from proof of work to proof of stake sometime in 2022. But Bitcoin, it's the first cryptocurrency to use proof of work, and it's unlikely to move away from the technology without a major overhaul. Before we go, former Fed Chair Ben Bernanke was on CNBC Squawk Box earlier this morning, and he weighed in on the crypto industry. Here's what he had to say.
It's a speculative asset, but it's one that whose underlying use value, gold has underlying use value. You can use it to fill cavities. The underlying use value of Bitcoin is to do ransomware or something like that. So one of the other risks that Bitcoin has is that it could, at some point, be subject to a lot more regulation. And the anonymity is also at risk, I think, at some point. So, investors in Bitcoin should be aware of that.
That's all for today. We are back again tomorrow, and we'll see you then.